The biggest Amazon aggregator, Thrasio, just filed for bankruptcy. Thrasio raised $3.4 billion from some of the biggest investors globally. Names such as Silver Lake, Oaktree, Advent, Upper 90, the list goes on and on. So how did some of the most prestigious investors get it so wrong? In this video, I will explain to you what they promised to the investors and what went wrong, and how you can learn from their mistakes. This video is not just about Thrasio, it's about the general Amazon aggregator landscape and why so many of the other big aggregators are actually failing as well. My name is Alexej and I help founders scale. Exactly 1 year ago, I posted on LinkedIn 10 reasons why Amazon aggregators will fail. And in May this year, Bloomberg posted an article how $16 billion raised are under risk. The story of the Amazon aggregator started in 2020 and 2021 when there was a massive bubble after COVID. There was so much capital, all the central banks were pumping money into the economy, and there were crazy bubbles, the crypto bubble, the D2C bubble, the SPAC bubble, and of course the Amazon aggregator. Central banks pumped in billions and trillions of capital into the system, and that money had to find a home. And of course, some of the businesses which raised a lot of capital were not recession proof. So going back to Thrasio. Now, one of the promises they made to investors was to acquire FBA brands, so brands which are listed on Amazon and the logistics are fulfilled by Amazon. The promise was to acquire these brands at, let's say, 2 to 4 times profit multiple. And then Thrasio was actually trading or hoping to list at maybe 20 times to 30 times profit. That is called multiple arbitrage. What usually private equity funds do when they roll up businesses and let's say they acquire one platform, a bigger organization, and then that organization buys smaller businesses as bolt-ons. They usually buy these businesses at a much lower multiple, and the overall group trades at a much higher multiple. So nothing wrong with this logic here. The second promise Thrasio made to the investors was to create a lot of synergies by combining the marketing function, the finance function, the supply function, and of course also have much more leverage with the suppliers, for example in China, when negotiating price. Now on paper, this all sounds really logical and really simple to do. But in reality, if you have hundreds of brands, it's actually much more difficult. The difficulty was supposed to be solved with technology. The big promise to solve that complexity with hundreds of brands was to use technology and to develop internal software in internal processes. But again, it was much more difficult than everybody thought. The third promise Thrasio made was to use capital and debt financing to acquire a lot of the different brands and also to finance a lot of the inventory. And in a world where debt and capital is really cheap, that makes a lot of sense. But because interest rates went up a lot, that capital became extremely expensive. So to summarize, you have multiple arbitrage, synergies, and using leverage to create value. That is a great combination in a bull market if everything is just going up. But when there is a recession, when there is inflation happening, where there are geopolitical crises left, right, and center, this equation promises a lot of trouble. In summer 2021, Thrasio tried to list on the public market, but the public markets by then started actually correcting. When Thrasio saw the difficulties around the public market listing, Thrasio tried to list via SPAC. SPAC is a listed shell which acquires private companies to enable them to list on the public market in a much faster way. So through a mechanism called reverse takeover, RTA. By the way, if you want me to do a video on that, please comment down below that you want to find out more about SPACs and reverse takeover. But back to Thrasio. In August 2021, the SPAC wasn't successful, and the discussions of both a public market listing and a SPAC basically failed. And investors had to come and do a big funding round, almost $1 billion of that $3.4 billion raised, to give Thrasio more cash and to extend the period of them operating with the hope that the markets will recover. From an investor's perspective, it was probably the right move, but you could also ask yourself, is it really that wise to throw more good money after bad money? Is it really that wise to invest more into what is a broken business model? So how is that business model broken? Let me explain to you. When Thrasio acquired brands, they acquired them actually at the peak of the sales cycle. So after the COVID slump, there was a massive recovery, people were staying home, people were buying online, and so sales were at the all-time high when Thrasio was acquiring the brands. On top of that, Thrasio paid usually a multiple based on the last 12 months of sales or the last 12 months of profit. And the last 12 months of profit, the margins were not adjusted for all the various geopolitical issues which actually started happening in 2021 and further 2022. So since then, the margins compressed big time. You had massive spike in logistics costs, you had a massive spike in raw material prices, and you also had labor cost inflation, which basically meant that if you acquired a brand at 4 times profit multiple, at a 20% profit margin, and the margin dropped to 10%, the multiple was actually 8 times you paid rather than the 4 times. So this massive decrease and margin compression is what ultimately killed Thrasio. So again, the sales were coming down because the brands were acquired at the peak of the sales cycle, and the margins were coming down. So basically a double whammy. And the third thing, which basically put the nail into the coffin, was the fact that everything was financed using leverage. And so when you pay suddenly 15% interest rates, but your margins drop from 20% to 10%, you suddenly have a 5% gap, which you basically need to pay using your equity financing. And therefore investors were like, well, we're not gonna finance you even more to now pay down the debt you have because you thought that that will remain forever so cheap. Now, a lot of the reasons I was discussing so far are fairly externally triggered reasons, which you could argue nobody can plan for. But if you actually look deeper into the operations of Thrasio and many of the other aggregators, you could see a really big mess with brands as well. So for starters, when I talked to a lot of the different insiders at Thrasio, inventory was a massive mess. Basically, a lot of the brands were running out of inventory and the teams were ordering just a lot of inventory. What happens if a brand runs out of inventory? Sales velocity usually takes a long time to recover. And sometimes it will never ever recover again. What happened is that there was so much inventory sitting in Thrasio's warehouses which could not be sold, that the only solution was to write it off. And I've actually heard a number of close to $500,000 of inventory being written off. Who was making these decisions? Well, let's discuss the hiring at Thrasio and again, some of the other aggregators. Now, if you replace a founder of a brand who's been running the brand for 10 years and hasn't been paying himself or herself, a crazy salary, and you replace these people with young MBAs from New York, from Boston, and you pay them 2 to 3 times more than the founder was making of the brand, and people who have no marketing experience, no supply chain experience, no Amazon experience, what you end up having is basically a mess. I don't want to make this video all doom and gloom because Amazon is actually an amazing ecosystem and platform. Amazon's ecosystem accounts for more than $4.3 trillion. There are more than 60,000 sellers on Amazon making more than $1 million each. That means it's a massively fragmented and huge market still to go after. A lot of critics say, oh, what about the Amazon dependency? Well, the reality is that the Amazon ecosystem is growing. Last week, Snapchat, Meta, so Facebook and Instagram, both announced collaborations with Amazon to allow the user on TikTok and Instagram and Facebook to basically buy something directly from Amazon without leaving the social media platform. That is huge because it now adds so many more users who basically discover products through Instagram or through TikTok who can now buy stuff on Amazon. We saw from the time the Amazon aggregator space started collapsing, we actually started looking into brands ourselves. In early 2022, we acquired a scented candles brand ourselves. We looked at more than 40 brands in total and decided that this is the brand we can really grow both on Amazon and outside Amazon. Since then, so in less than 2 years, we optimized the listing. We made sure we never run out of inventory. We added many more and smarter marketing campaigns. We launched more products. We launched in more geographies, and we constantly look into product R&D and innovation to basically have a differentiated product out there. Of course, we also leveraged our SEO and performance marketing experience to basically launch the brand outside Amazon as well. So instead of acquiring multiple brands and hundreds of brands, we just focused on one brand and doubled down on that amazing brand to grow it multiple times. We wrote a really detailed case study on that journey, and if you click in the description on the link, you'll get to the NUOPTIMA case study page. Have you considered actually acquiring a brand yourself? With a lot of the Amazon aggregators going bust, there is a lot of opportunity to buy extremely well-valued brands right now. The 3 things I would watch out for is a really good rating, repeat customer, and the potential to launch beyond Amazon. If you want us to help you to grow your brand and to make it more profitable, get on a free call and we do an audit of your brand and give you a 20-point list how to increase the sales and the profit of your brand. If you like this video, click like and please subscribe to the channel.